First, I'm going to talk about a concept that I call the value gap. Second, I'm going to show you how we measure the value gap and how it's instrumental in everything we do, from picking stocks to building our portfolios. And then finally, I'm going to discuss a new fund that we have launched in order to help clients benefit from the opportunities that we see before us in the small cap world that both Arnold and Steve spoke about. So let's begin first by identifying and defining the value gap. Simply put, the value gap is the difference between the price of the stock and the underlying value of the business. If you recall Ben Graham's famous quote where he said, "In the short run, the market is a voting machine, but in the long run, it's a weighing machine," that's exactly what he was describing. He was describing how in the short run, market gyrations move stocks all over the place, but the underlying value of the business is what defines the price over the long run. And as value investors, that is our goal. Our goal is to capture that gap, the difference between price and value. Now, the value gap, there's three components. There's the price, there's value, and then there's time. And we're going to address all three of them. So let's start with price. This is a very generic chart of price, two stocks, stock A and stock B. So I think if we look at it, we can all agree that stock A moves up and down much more than stock B does. Now, how people perceive this up and down movement, or what is also called volatility, differs from some groups to others. The value investor looks at it and says, "Oh, look at stock A. I see great opportunity to buy low and sell high." The academic, however, looks at that and says, "That volatility, I see risk," because the academic assumes that price and value are always the same. You see, for them, for their formulaic theory, the price and value must always be equal, or the formula doesn't work, it won't balance. However, for the value investor, he understands from both experience in the marketplace and just plain common sense that they're not the same. In fact, it's the volatility that occurs in the marketplace that creates the opportunity to buy low and sell high. And this was the genius in Ben Graham's quote, because he understood that there's a lot of reasons people vote on stocks in the short run, without regard to what the underlying value is. But at the long run, it's the underlying value that always plays out and dictates the stock price eventually. So that brings us up to the next component of the value gap, and that is value. If we look at the goal of value investors, it is to value the business, compare it to the value the business and compare it to the stock price. And when that stock price differential, the difference between the price and the value, is big enough and it meets their hurdle rates, they'll buy the stock. Pretty simple. We think there's one flaw, one thing lacking in that, and that is that approach often doesn't measure how wide that value gap gets. It doesn't measure how wide it gets and how, especially at the extremes, and then how narrow it gets when the market recovers. And it was this void, along with the teachings of Ben Graham, where Arnold developed a different methodology, which we call the HMA, or the historical multiple analysis. This is the fundamental tool on how we value every company in our portfolio. So you see, Arnold developed this about 38 years ago so that we could capitalize on the value gaps when the volatility created those gaps. He understood that in order to capitalize on it, we need to address three primary issues. One, we had to be able to appraise the fundamental value of the business and separate business risk from price risk. We also had to take that valuation and apply it across economic cycles so we could see how wide the gap would get. And then we had to employ a margin of safety approach so that it instilled discipline in buying and selling companies. And from all of this, the HMA, or the historical model, was born. They don't teach it in business schools. It's unique to Century Management, and again, it's the cornerstone of what we do. So I went back into our corporate libraries and pulled out an earlier version of our HMA. This is from 1983. It's the first page of a 4-page HMA at the time. It was for Procter & Gamble, and Arnold at this point was looking at the low prices of the stock and getting his buy point. And the thing you'll notice that stands out is it was all handwritten. And knowing Arnold, if you know him, you know his handwriting hasn't changed a bit since then. So he's a very consistent man. But what we also see is this is before the digital world. And the reason it was handwritten is because we couldn't download the information. So we had to dig through annual reports to pull it out. We didn't have the automatic downloads that you have, and Al Gore was still in his basement creating the internet, so we didn't have that benefit either. But we had to go through annual reports, 10Ks, 10Qs, and extract years of data, and then boil it down to the pertinent information, and then put it into the template. So as you can see, before the digital world, much of what we did was kind of offline as opposed to online. This is the new HMA. This is the 2012 version. Now, I know you can't read it, and I don't expect you to be able to, and don't worry, we're not going to go line by line on this. But I wanted to show you what it looks like just to give you a sense of what it is that we do. So Arnold's Baby has now grown up to be a multi-tab Excel workbook where a complete analysis with an HMA, a 5-year forecast, and a segment analysis prints to about 20 pages. We break down our HMA into 4 sections. The first part is the income statement. The second part is the balance sheet and leverage ratios. The next part is our historical prices where we compare it against valuation metrics. And then finally, we put it all together and put it into numbers where we have our buy point, sell point, and we call that our valuation structure. So let's look at the income statement and what we look at when we look at the income statement. This is a 20-year look. So we're looking back over 20 years of the income statement and the financials of a company. And we do this for a lot of reasons. But in doing it, we're assessing the sales, the margins, the growth rates over the past 20 years. We're looking at the cyclicality of the business, how profitable the business is, how much cash it generates. And then we look at each segment and how each segment impacts the whole. In essence, what we're trying to accomplish by looking at this is we want to see how the business operates during recessionary periods, and there's a lot of them during the last 20 years, what happens to sales and margins, what happens to the growth rate, what happens to the profitability in those down years. And then we also want to see how the business has changed, how has it evolved? Because it's how the business has operated in the past, how it is now, that helps us project what's going to happen over the next 5 years and create our best case scenario or the most appropriate scenario based on today's environment and what we see and how the company is structured. In the next section, we look at the balance sheet. Balance sheets are very important. We want strong balance sheets, so we're looking historically, again, over a 20-year period, at the changes in the capital structure, the debt levels and the debt ratios. We want to study what acquisitions have played on the business, how the debt has occurred. Has it come from acquisitions or from share repurchases? We look at hidden assets and hidden liabilities. And again, all from with the idea of looking at how the business has cycled through economic downturns, where it is today, and what we can expect going forward in the future. So up until this point, we've been analyzing, kind of how the business works, what makes it tick, and how does it operate during recessions, recoveries, and peaks. This next part of the HMA is where we look at how the market prices the stock relative to its valuation metrics in those downturns and in the peaks. We've got 14 different valuation metrics that we apply, and we're looking at how it's priced relative to those metrics during all the down years and all the up years. And there's patterns that occur. There's patterns that occur in industries. There's patterns that reoccur in individual businesses as well as the markets. There's some companies, for example, that are very steady, and they grow at a pretty even keel. And so all the 14 metrics that we look at are relevant, and they're consistent, both at the top and the bottom. But there's other, more cyclical companies where 14 metrics aren't really relevant, and maybe it's 1 or 2 that are the most relevant. I'll give you an example of that in a couple of slides. And then finally, we take everything we've learned about the company, about the industry, from a valuation standpoint, how the business has changed, and we quantify all that in what we call our valuation structure, which is where we have our worst case, our buy point, and a sell point. So again, the worst case, we're assuming a recession. Don't know when it's going to happen, aren't predicting it's going to happen today or tomorrow, but sometime in the future, we know we're going to have a recession, so we assume that. We look at the fundamentals that we would expect in a recession. Arnold talked about that with Cisco. We apply recessionary multiples to those fundamentals, and that becomes our worst case. Our sell point, we're looking at recovery level fundamentals and applying recovery level multiples. But in order to get the buy point, we require a margin of safety. And the way we look at a margin of safety is through our reward to risk ratio. So Arnold mentioned this earlier, 3.5 to 1 is what we want for big cap stocks, and 5 to 1 is what we want for small cap stocks. What that means is we want 5 units of upside for every 1 unit of downside. So for example, if we have a stock that has a sell point of 20 and a worst case of 8, in order to get 5 units up and 1 unit down, we can pay no more than $10 for that stock. At $10, it gives us 2 points down, 10 points up, 5 to 1. That's our required rate of return, or required margin of safety, if you will. And so that's how we arrive at that. We take all of that, we do this for every stock, and put them all into a database, a spreadsheet that we call our dashboard. And then we sort that dashboard by the reward to risk ratio. So we want the highest reward to risk ratio we can get. That means the stocks are the cheapest and we've got the odds in our favor. That's how we manage the portfolio from an individual stock and from a portfolio standpoint. So those with the highest reward to risk we buy, those with the lowest we sell. And this is what we're looking at every day in our portfolio management meetings, analyzing the businesses, looking at the buy points and sell points, and then building and constructing portfolios along the way with that. And it also dictates the weightings of each individual stock in the portfolio. So I said I was going to give you an example. So now let's take a look at Apogee Enterprises. This is a stock that we own. And by way of background, Apogee has 2 segments. They have high-efficiency glass and window systems that they put in high-rise buildings like this hotel and downtown, all the glass here in Houston. They're a part of that. They also do the non-reflective glass for art, for pictures, so it's in museums and such. It's a smaller part of their business, about $100 million in sales, but very profitable. But the bulk of their business is the high-efficiency glass. They're the market leader in each of their industries, where they are expanding internationally. They've got high barriers to entry. It's a difficult process. You can't just buy a coder and set it up and think you're in business. It's also not something easy to ship from China on a boat. It takes 3 months to get here, and it's hard to get just in time on a construction site. I can't imagine a contractor would be too happy when it's late. So it's a very regional business. From a balance sheet perspective, it's got a very strong balance sheet, about $1 in net cash on the balance sheet. But it's a late-stage cycle business, which means that at the bottom of the cycle, it generally loses money or doesn't make much money. And at the top of the cycle, it's making a lot of money. And in between, it's growing its earnings appropriately in between. But what that means is in the beginning of the cycle, there's no money. It doesn't report much in terms of earnings. However, it generates free cash flow throughout the entire cycle. So now, instead of going through an HMA on Apogee, because you'd never see it, I converted the relevant information in HMA from a valuation standpoint into a series of charts. So this next series of charts is how we look at Apogee from a valuation standpoint. So on this chart, I've isolated the tangible book value per share for Apogee Enterprises, which is one of the 14 metrics that we use to value businesses. As I said, with companies like Apogee, it's a cyclical business, so it doesn't show much earnings at the bottom of the cycle. So earnings-based valuation metrics can often become meaningless. For example, if you have a $10 stock and it's earning 10 cents, that would imply 100 PE on the stock, which is very expensive from a PE standpoint. And which is why you often see when companies are cyclical and they're losing money, analysts often, especially that solely use earnings-based models, immediately put sells on it or don't cover it or drop coverage because they don't have any other way to analyze it, which is why we use a multi-valuation approach to it. And in this case, in cyclical companies, we look at tangible book. That's our favorite aspect to look at. And now, those that may not be familiar with tangible book, if you take all the assets of a company, subtract all the liabilities, you end up having net worth or tangible or book value. Then from that, if you take goodwill, patents, copyrights, and subtract that off, you have tangible net worth. So now if we look at the chart, you can see that while there's been ups and downs along the way, the tangible net worth of Apogee Enterprises has grown rather steadily over time. Now it's cyclical, so there is some ups and downs, but over 20 years of all the economic ups and downs, it's grown pretty nicely over time. Now let's look at the stock price. Kind of volatile. Gone from $5 to $25, back to $5, up to $10, down to $5, back up to $30, back down to $8. So Again, value investors say, I see opportunity in this. The academic says, it's too risky, I don't want it. Now, the buy low, sell high is our kind of stock. So this is a great opportunity for us. But we have to have a methodology in how we can compare the price to the value. So now let's look at this next slide, where we do compare price and value. So these are on the price and the tangible book value. That's the last two slides combined here. That's what this is. And they're both on the same scale. And what you'll notice is every time the price hits tangible book, it's the bottom. And it doesn't last that long either. This also coincides with the time that the stock is the cheapest and where the reward to risk is the greatest. Unfortunately, it's also the time where most people are fearful of volatility and seek low volatility, exiting out of stocks like this or not even looking at stocks like this, and in the process give up great opportunities. So now let's look at the next chart. We saw how it bottoms at tangible book, but now we need to convert this into a ratio of price to tangible book. This way we can see what the price to tangible book ratio is at any time over the last 20 years. So the numbers going up the side, the 1 represents that the price is equal to tangible book. 2, 3, and 4 means the price is 2 times tangible book, 3 times tangible book, and you can see it peaks at 4 times tangible book. And so now if we look at where our value zone is for this stock, anytime it gets near 1 times tangible book, it's cheap. Anytime it gets to 3 to 4 times tangible book, it's expensive. And now, as I said, when we wrap everything up, we put it into our valuation structure. For us, the worst case on the stock is 90% of tangible book, which would equate to $8. Our buy point is 1.15 tangible book, so that's $10, and the sell point is 3 times tangible book, or 26. If bought at 10, we have an 8-to-1 reward to risk ratio. Do you see how volatility can play in your favor when you have a process that can value a business and captures that value gap? That's what we do. That's the difference. And it's not just looking at what hurdle rate is. We want to know how wide that gap gets. At 2 times tangible book, you could double your money from 2 to 4, but it could also go down to 1. And that's what we try to capture when we look at stocks and understand how wide that gap gets during economic downturns. So this is a great example of the value gap and how our process captures that, and that captures the opportunities that volatility creates. So now value gaps, they come in all shapes and sizes. They can occur one at a time. They can occur all at once in major market downturns. It happens in all industries, all sectors. It's for this reason that Arnold started, when he started the firm in 1974, that he adopted an all-cap strategy so that we weren't limited to cap size. We could go wherever the value was, and we weren't limited by industry. So wherever the value is, big or small, this industry or that, we're looking at capturing value gaps no matter where they are. Relative to the index, our portfolio has a smaller cap tilt to it. Now, that's not the first time in history that happens. It's been often the case throughout history, and the reason is pretty simple. Small cap stocks are more volatile over time, and that movement means that small caps hit our buy points more often over time than big cap stocks do. So naturally, if smaller companies are hitting our buy points more often than big cap companies, they're going to be a bigger part of our portfolio. And it's a good thing because small caps have a bigger reward to risk ratio than big cap stocks do. And by doing so, they've been a bigger part of our portfolio and been major contributors to the performance over time. Now, the recent push that we've had for market participants to avoid this volatility has been pushing them into the big cap dividend-paying stocks, which we saw in the index review. This is creating voids throughout the rest of the marketplace, and in one area that we see in particular is the small companies. So as Arnold said, and Steve mentioned in his discussion, we think there's a lot of opportunities in the small cap world going forward, and the environment is starting to get ripe for that. However, even after this discussion, you still may be a little uncomfortable with the volatility in small cap stocks, but that's okay. You'll get comfortable with it, I assure you. If not, I'll just come back talking till you are. But anyways, so last year we developed and opened up a small cap mutual fund that's dedicated to small cap stocks called the SEMA Advisors Small Cap Value Fund. But we did this we started the fund so that we could offer the performance that small cap stocks have to our clients, but doing it with increased diversification that just isn't possible in an individual account. So for example, in a typical individual account, we might be able to buy 10 to 30 small cap names. In the small cap mutual fund, we can buy 60 to 90 names. So there is increased diversification in the fund. But there's some additional benefits to having a fund format. One, we can buy companies that have much smaller float, which makes it impractical for us to buy and equally distribute amongst all the client base. So we can buy those in the fund. And the fund format also has increased benefits of scale, which allows us to accumulate in smaller percentage increments without additional commission costs. I know how sensitive everybody is for commission costs. We also have access to a much broader range of brokerage firms. All of you have your individual account at one broker, and that's predominantly where all the trades are done. From the fund, we can buy stocks across 15 different brokerage houses, which allows us to buy stocks wherever the volume is in the marketplace. It may not be at your brokerage firm, but it can be elsewhere. So we can go, and it's important in small cap names, to go wherever the volume is. So from a process standpoint, when we look at the individual, how we buy and sell individual companies and how we build a portfolio, it's done the same way in the fund as we do in individual stocks. The analysis is the same. The risk and reward requirements are the same. So, but in everything we do, whether it's in the individual portfolios or in the fund itself, creating a margin of safety is a significant part of our thinking. And so, but that starts in the screening process. So when we're screening for stocks, and I'm going to use a small cap example for this, when we're screening for small names or small cap companies, there's 4 primary criteria we look at. We want low financial leverage, meaning we want good balance sheets. We want high operating leverage. We want a wide range historical valuation range, which means we want big value gaps. And then we're looking at structural changes within industries. We want structurally sound industries. So let's take each of these in turn. The low financial leverage, what we mean by that is we want 25% debt to capital or less, so very strong balance sheets. We're not interested in having bankers become business partners. They have a different agenda and sometimes muddy the water, so that's not of interest to us, so we want very strong balance sheets. Second, we're looking at high operating leverage. What that means is we want companies that are under-earning their earnings potential. And a lot of times this means it's a cyclical company. It's like an Apogee Enterprises that makes maybe 10 cents at the bottom of the market, and at the top will make $2.50. So there's a wide range in their earnings. So the earnings growth is wide in these companies. That also, it doesn't have to be a cyclical company. It could be another business where they've added another end market, or they've added a new product line where that incremental revenue contributes disproportionately to the margins. And then we want, as I said, wide ranges in the valuation range. Basically, we want a big difference between the buy point and the sell point. You make more money that way. The wider the gap, the more money you make. And then finally, structurally sound industries. What we mean by that is value investors are usually many times looking at companies that are out of favor. Their industries are in down cycles and they're out of favor. So it's really important to differentiate between a cyclical downturn and a structural shift in the industry. A while back, we were looking at the energy industry. We're always looking at the energy industry, but in studying the oil and gas industry, I'm sure many of you are familiar with that in Houston, the fracking technology has opened up vast reserves and created tremendous production of natural gas, which has brought down the cost of natural gas, which has meant those that are drilling purely for dry gas are suffering. Their drilling costs or their cost of production is much higher than the gas price today. That's a structural shift that we've seen in the gas industry. So that means we want to avoid those companies that are going to suffer because of it. But it also opens up opportunities to those that will benefit because of it. For example, the chemical companies are benefiting because of the low natural gas, which means we're seeing, as Arnold pointed out, a tremendous amount of money being invested in new capital spending programs for gas business, for chemical companies. So that's an opportunity for us to look at companies that will be supplying the chemical build-out. So Jacobs Engineering, for example, a big construction company, they're big in building chemical plants. But we can go down the line from Jacobs and look at other companies, some here in Houston, like Powell Industries, that supply capital equipment to that industry. So looking at structural changes within industries helps us avoid some, but get into others where they're going to benefit, where the wind will be at their back. So once we've done all this, so once we've gone through this screen, we do our HMA analysis like I showed you with Apogee, and then take all of those and put with our worst case buy point and sell point and put it into our dashboard. And from that, we sort based on reward to risk ratio. So now let's take a look at our criteria that we screen on and buy stocks on, how that gets represented in the portfolio. So currently, the fund has 60 securities, and the average market cap is $720 million. That compares to 1,400 securities in the Russell 2000. In the 2000, there's 1,400 that are in the value, categorized as value, and their market cap is about $1 billion, the average market cap. And then if you look at the S&P 500, there's 500 companies, $115 billion. So where we're finding value tends to have a smaller tilt, even relative to the small cap index itself. Now let's look at whether our screening, their screening process, how that's reflected in the portfolio. As I said earlier, we want really good balance sheets. So we're screening for 25% debt to capital or less. What we actually have is 12.5% debt to capital. So we have exceptionally strong balance sheets. In fact, if you were to add cash to that number, we'd virtually have no debt on a consolidated basis on the portfolio. That compares to 39% in the Russell and a roughly 37.5% in the S&P 500. We wanted a high operating leverage, which means we want growth in our earnings going forward. Here you can see the 3 to 5 year projection. These aren't our projections, by the way. This is consensus estimates by FactSet. So our growth is 10.39, slightly higher than the Russell 2000 itself, and slightly less than the S&P 500. So again, we show good growth in earnings going forward. Now let's look at from a valuation standpoint. We want to buy them cheap. So this is a metric that we use called enterprise value to sales. Arnold spoke about this earlier when he said you can either invest in a new business or you can buy another one. And if you can buy another one at 45 cents on the dollar, it's cheap. Well, here we are. Our portfolio is 49 cents on the dollar. That means you can buy the company, including the debt, paying off the debt, and it's 49 cents on the dollar, relative to the Russell 2000, where you have to pay just about a dollar for dollar, 95 cents on the dollar, and the S&P, you have to pay 1.6 times a dollar. So from a valuation standpoint, we're cheaper than both indexes. Now let's look at price to book. 1.1 for the fund, 1.19 for the Russell 2000, and 2.18 for the S&P. Now, to be fair to the S&P, it's always going to sell at a premium to the small cap funds, but nonetheless, you can see the fund has a much better balance sheet than both the indexes. It's got very good growth prospects, and on valuation, it's cheaper than both funds. So we've seen that the small cap stocks on their own are relatively cheaper than the indexes. Now let's look at it from an absolute standpoint. We've already talked about how we take the reward to risk of each stock and put it into our dashboard. Well, what this chart represents is the reward to risk for the fund itself in total. So we take all of the reward to risk ratios of the holdings of the stock and create a reward to risk ratio for the entire fund itself. We started the fund in April 18th of 2011, which is all the way on the left side of the chart. At that time, the reward to risk ratio is 1.81 to 1. Not cheap at all, which is why we funded it with internal money. Then you can see during the third quarter of 2011, when the U.S. was supposedly going to default on its debt, when you had the problems arising in Greece and Europe, you had the fears of a double-dip recession, and all of that fear caused people to sell stocks. And what happened to the fund? The reward to risk ratio went from roughly 2 to 3 up to 5, then up to 8, and then for 15 minutes on October 3rd, 2011, it went to 8 to 1. But that was 15 minutes of the day. The day before it was 10 to 1, the day after it was 8.5 to 1, and it's never been that high since. But look at period of time that was. It was a very short period of time. So when everybody else was selling, it was creating tremendous opportunities for us to buy. We bought individual stocks. We saw the cash in the all-cap portfolio go from 30% down to 12%. That was us buying companies during that time frame. Let's take a look at it from another perspective. This is the same information, but I put it into a tabular form. So if you look at the 5 to 6, what that means is any time that the fund offered a 5 to 6 to 1 or better, 5 to 6 reward to risk ratio, that's the yellow bar. The frequency means in the second column where it says 21, that means there's been 21 times where the fund had sold between 5 to 6 to 1. And if you look at the cumulative where it says 56, there's only 56 days in the 350 days that the fund has been open that it has been higher than 5 to 1 reward to risk ratio. That's equal to just 16% of the time. And if you look at 8 to 1, it's only been there 14 days, 2 weeks at 8 to 1 or higher, which is 4% of the time. So in those downturns, it feels long. That 56 days, that's about 2 months. It feels long, but it's not really. It's not really that long, and that's the time that we have to buy. That's when the most opportunity is available. Now, where the fund mostly is in the 3 to 1 or less. That's 68% of the time. What this means is we don't have a lot of opportunities, but when they are, we must take them. So just like in small individual companies, at 5 to 1, we think it's the buy point. At 8 to 1, it's a gift. But it's all about buying the value gap when it's apparent. So while I can't predict when the fund or any individual stock or index or, for that matter, any of them can get to a reward to risk ratio that we've just seen, what I do know is that human nature repeats itself, and it will continue to create value gaps. And when it does, we certainly have the methodology, the process, and the mindset to be able to capitalize on them whenever they happen and wherever they happen. For individual accounts, we're going to continue to execute our all-cap strategy just as we always have with the principles that both Arnold and I outlined. So with that, I'd like you to leave you with one last thought. And that is the next time that volatility spikes and you get a bit nervous, because I know everybody does, then think about Ben Graham's quote and remember the value gap and how do you capture that value gap. Because not only will that calm your nerves, it's going to make you money. Thank you very much.